I'm pretty sure that all of you watching this video know about what index funds are and what the strategy behind purchasing index funds is. Today I dive into how index funds have become a bubble and how they likely represent the most risk to the average investor since the subprime mortgage-backed securities bubble, so stay tuned. Hello everybody, welcome back to this channel. I call this channel the Contrarian because I typically come to different conclusions than the majority of other investors out there. And in my decision-making process, I look at the facts. I don't look at the overall sentiment. And also, I don't have any sort of vested interest in you not holding index funds or in buying anything else. And I've already made a couple of videos regarding the passive investing bubble, but I just want to warn people about what I see and what other people out there see. And those willing to listen can listen, and those who aren't willing to listen don't have to. So to get started, let's go over the basic idea of what index funds are supposed to be. And index funds are a relatively new invention in that the first index fund was created by Vanguard in August of 1976. So actually looking back prior to, say, when the S&P 500 or the Dow or the NASDAQ were created, it's all sort of relative, because looking back before when they were created, the index fund price is calculated on the summation of the individual stocks included in the index back at the time. And as you might imagine, some of these stocks didn't even exist yet. So there's all sorts of statistical errors in doing this sort of retroactive calculation. There's not very much data to go off of, given how long these index funds have been in existence, and none of them, even the one created in 76, have had to go through a major market correction. And I'm not a statistician, but I am sure that they would be pulling out their hair in doing these sort of retroactive calculations. Now, more importantly, the basic idea of an index fund is that you aren't trying to outperform the best money managers or the best professional investors out there. Rather, you are trying to mimic what they collectively are doing. So, what assets is their money allocated to, and what is the weighting that they give to these asset classes. So this is what is known as a passive form of investing. You aren't making rational decisions about each of these stocks you buy when you buy an index fund. You are rather letting the managers of the index fund decide which stocks are good and which are worth giving a pass. So when you buy an index fund or index tracking ETF, all you are doing is buying a bundle of whatever stocks are currently included in that specific index fund or ETF. And when you sell it, you are selling all the underlying stocks. It's that simple. Now, all of this works in this scenario while the passive group of investors is very small. And a good analogy of this is, picture you and a few of your friends are riding in a canoe and you want to travel at the same speed as a cruise ship. And let's assume that you're successful at tying a rope to the back of the cruise liner, and your small canoe can likely, cruise along at the same speed as the cruise ship, and it won't impact its speed at all. And you would still be traveling however fast they were originally. But however, if you and all of a sudden 500 other people are now trying to be towed by the same original cruise liner in a ship of roughly the same size as this original cruise liner, you will now travel significantly slower, if at all, and the whole system breaks down. You're now the same size as them. And this is roughly where the situation of passive investing and active investing are right now. Inflows into passively managed funds have greatly outpaced actively managed funds since the financial crisis of 2008, and the total amount of money managed in active accounts is now roughly equal to the total amount of money passively put into passive accounts. Now you might be asking, how could this be a problem? How could this create another scenario similar to what happened to the subprime mortgage market in 2008? And here is where the ballooning of passive investing world has created another problem. And another assumption behind passive investing is that it is in fact passive, that it won't affect the market it is attempting to follow. And as you can imagine, once you have roughly half of all asset purchases or asset sales being done without any fundamental analysis done to them, simply due to the buying or selling of the underlying bundle of stocks included in the index, this is not, in fact, a passive way of investing. It influences the market a significant amount. So in other words, the explosion in passive investing popularity has resulted in immense distortion to the valuations placed on the underlying assets included in these index funds. So passive investing has become active in its own way, but it is the most basic of all algorithms imaginable. All the passive algorithm says is if a share of the index fund ETF is bought, buy the underlying stocks of one index fund ETF share, and if one ETF share is sold, sell the underlying stocks. And if you have if you have half of all asset purchases or sales being done solely on this basis, this very, very simple algorithm, and not on any sort of valuation standards, you quickly can run into problems. And just think back to 14 months ago, although this was not a very severe crash in terms of magnitude, it was by far the quickest in stock market history. The Russell 2000 was down as much as 40% in a matter of 6 weeks. And these kinds of extreme volatility were formerly unthinkable, but they are now possible due to passive investing. What was the reaction of a significant number of investors when the news of COVID first came out and when the markets first began to tank? Sell some, if not all, of the index funds. And in doing that, the algorithm of passive investing went the other way, dumping massive volumes of these small companies, in the case of the Russell 2000 and the S&P 500, massively higher than the typical daily trading volume in these individual stocks. And this, of course, resulted in these individual stocks crashing until a buyer would step in to purchase the shares at a significantly lower price. And because the prices of all of these individual stocks fell, the price of the index fund fell as well in an extremely volatile manner. So here is another analogy by Michael Burry, who roughly 1.5 years ago warned of this immense problem in passive investing, and he actually did have a short position on index funds during this crash in 2020. But in my opinion, this is still a very relevant, if not even more relevant, analogy that he gives. Picture a large building with one door to go in and out, and people can gradually move in and out. But if the crowd decides to run one direction or the other, it will not be possible for everyone to leave or enter at the same time, or even in a small amount of time, as there is only one door. And so in the same way, index funds and passive investing can and have worked fine when the inflows and outflows are gradual and within the typical daily trading volume of these underlying stocks. However, when this volume is exceeded, as is typical during a market sell-off, the prices will crash significantly farther, causing more selling, causing more price drops, and you enter into a very quick and vicious cycle. So these are the sort of risks currently underway with owning passive investing vehicles, whether they be ETFs or index funds, just anything where there's a very simple algorithm simply saying to buy or sell the underlying assets only because you are buying or selling the index fund or ETF. Now you know the risks out there. You can make your own decision. I'm not going to tell you what to do, but in my opinion, this is still a very, very relevant subject right now. If anything, we're even more leveraged than we were before the crash in early 2020. So this is all for you to take in, and I hope you enjoyed this video. If you liked it, give it a thumbs up. If you didn't like it, give it a thumbs down and let me know why down in the comments, and I hope to see you again.